The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Scarlett Fu here with Vonnie Quinn. We see markets holding up and that the S&P 500 is near record highs, but hasn't actually moved a whole lot this afternoon.
So many cross currents for the market to deal with. Look, we're almost at 6,300. We're flat on the S&P 500, but about half the companies in it are higher and half are lower. We also had, of course, the comments from Chris Waller today on Bloomberg Television, reiterating his case for a July rate cut. The FT is reporting that the president is pushing for a minimum EU tariff of maybe 15-20%. You heard the president talking just there about tariffs on BRICS and other countries, and when he sends the letter, that's the tariff. So there's a lot going on in this market. Profit taking as well, no doubt, given that it's Friday.
All right, well, let's kick things off right now and begin our market discussions with Jim Bianco, president at Bianco Research. And Jim, Vonnie mentioned the comments from Chris Waller, the Federal Reserve governor, and of course, he sounded a fairly dovish note. He was pretty dovish beforehand, but making his case for a July rate cut. That combined with the data that we did get, including the most recent consumer sentiment data from today indicating inflation expectations improving, does that put a July rate cut closer to a reality?
No, I don't think it does. I think it puts us closer to the reality that we're going to get Waller and maybe one or two other Federal Reserve officials to dissent. And he made his case as to why he wants to dissent at that meeting. And I'll point out that he said that, you know, he was in favor of the rate cuts last year at this time, and it turned out that those weren't necessary either. So at least he realizes that, you know, it's a guess. So I don't think we're going to get a rate cut in July. I don't even think we're going to get a rate cut in September, but we're probably going to see more dissents.
Jim, I want to ask you about the US dollar, because as we see the president signing the Genius Act right now, we know that that's going to lead for demand for treasuries. The president talking about how, you know, he wasn't going to let the dollar status slip, but we know the BBDXY is down nearly 10% so far this year, the DXY down 9%. It has been slipping. Is the thinking that the more demand for treasuries coming from perhaps, you know, the expansion of the stablecoin universe, that that's going to help in some way, the dollar, I mean?
You know, I'm going to push back on that, and I don't think we're going to see the demand that they think we're going to see on treasuries. What you're going to get at best, first of all, let's talk about what is a stable coin. It's a money market fund without an interest rate. It trades at $1 like a money market fund. It's backed 1-for-1 by treasuries like a money market fund. But a stable coin does not pass through interest rate or a yield like a money market fund does. At best, you're going to see some people take money out of money market funds, put them in the stable coins. That's not going to change the demand for dollars. You know, that's not going to change the demand for treasuries. And what you have seen with the treasury market, I think as of late, since about May, is it recoupled, is that the dollar tends to strengthen when yields go up and it tends to weaken when yields go down. So if we do get into a period of you know, continuing falling yields, I think you're going to continue to see the dollar weaken. If the yields go up, I think you'll continue to see it strengthen. That's the way it was before Liberation Day. It kind of lost that for a while, but I think it's back.
How are you thinking through tariffs and the new threats, the latest threats from the president, Jim, of 15 to 20% on EU goods, as well as the president's pronouncement that when he sends a letter, that's essentially a trade deal from where he sits? It looks like investors are kind of not writing it off, but looking past it for now until they see hard evidence that it's playing into their results, company results, or inflation data.
Yeah, I think that last part is right, in that what investors are doing right now is they're waiting to see signs of who is paying these tariffs. Now, we know from the Treasury Department that there is a big jump in customs collected or tariffs, and it's going to be to the tune of a couple of $100 billion this year. Well, somebody's paying that. Is it the exporter like the Chinese? Is it the importer like the company with its margins being squeezed? Or is it going to be the consumer with higher inflation? Right now, we don't see it really in any of those because it's too early. But I suspect that we're going to see it a lot more in the consumer side. We're going to see that those inflation numbers in the second half of the year are going to start to trend up, and that's when the market will react. But for right now, I think it's kind of, you know, in a limbo trying to figure out where we're going to go with this, who's going to pay these, and how big they're going to be. And I might also add that if we remember after Liberation Day, it was the stock market decline that got Trump to give us a 90-day pause. Well, with new all-time highs, he's got no reason to back off. He's going to be very aggressive with these tariffs and with his tariff proposals. until the markets give him a reason to back off on it, and so far they're not.
All right, good stuff. Jim Bianco, president at Bianco Research, kicking us off here as we count you down to the market close about 30 minutes from now. And of course, one of the various things that investors are assessing is the state of corporate earnings. We're keeping an eye on bank stocks after the big ones reported results this week. Goldman Sachs, Bank of America, Morgan Stanley, JP Morgan, Citigroup, am I missing
all of them?
Wells Fargo?
And some of the regionals too.
There you go. And of course, we've got another week coming up of regional banks as well. So here to wrap up all of the action for us, that we've seen so far at least, is Betsy Graseck. She's Global Head of Banks and Diversified Finance Research over at Morgan Stanley. Betsy, great to speak with you. What's your takeaway from the earnings that we have seen this week?
Things are good. We had a very strong earnings season.
Betsy, I'm curious how concerned the banks are, or perhaps you even, that we might be in for some kind of a period of financial repression if we see a change at the top of the Federal Reserve and perhaps a more dovish Fed.
I don't think anybody's really talking too much about concerns over increasing financial repression at this point, especially given the fact that we are still moving with our current structure through middle of next year, and we have no announcements to react to at this stage. But what I do want to highlight here is on bank earnings, which were very good. There's a couple of key drivers. One is capital markets that has started to accelerate, and I think what we heard on the calls was pipelines are building, and the execution on those pipelines are just beginning. So the second half looks pretty robust into 2026. In addition, loan growth, especially commercial and industrial loan growth, is picking up meaningfully, not only across my banks, the large cap banks, but also my colleague Manan Gosalia's mid-cap bank coverage. So these are the two reasons why I was, very exciting from an earnings season.
And we've seen a lot of these banks either raise or at least maintain their net interest income guidance for the full year. What do you think that reflects more of? Extreme caution in the first quarter to give them that led them to give conservative outlooks, or an actual material improvement in the last 2 months?
I think there's a couple of factors here, and every company is different, run by a different management team. So some are very conservative, but I would say the main reason for upticks in net interest income guidance where we got it is a function of the outlook for loan growth picking up a bit with real improvement in the quarter that we got, in addition to some better outlook for rate cuts. Look, half of my coverage, most of my coverage at Morgan Stanley is asset sensitive, so fewer rate cuts is better. And the mid-cap banks are a little bit more liability sensitive, so for them, more rate cuts is better, but they got some nice loan growth lift. So I think it's depending on where you sit on the asset liability sensitivity side of the spectrum, it was either higher for longer was good or loan growth picking up was good.
I guess something for everybody. You do have some of the major banks profiting from the volatility, Betsy. Do you see that continuing throughout the year, and will they continue to be able to take advantage of that?
So the volatility does help trading revenue, but at the same time, volatility, when it's too high, hurts investment banking fees. So as we have seen volatility come down, trading revenue off a little bit, but at the same time, investment banking fees pick up. We saw that in the quarter with M&A fees picking up quite nicely, as well as equity capital markets. So there is a balancing act here, and volatility coming down net, I do believe is positive, because you've got a broader set of investors that are interested in trading at the same time as your investment banking fees benefit.
Sounds like you're looking forward to an exciting rest of the year, and so are we. Will be talking to you each quarter. Betsy, thank you so much. That's Betsy Graseck, Global Head of Banks and Diversified Finance Research at Morgan Stanley. Staying with the banks, I want to bring in Steve Steinour now, Chairman, President and CEO of Huntington Bancshares, which just reported results earlier today and beats on plenty of the metrics. So congratulations, Steve. Curious if you think the market should be rewarding you more.
Oh, definitely so. We had a great quarter, this third one in a row where we've been peer leading. And we're investing a lot in it that will sustain the growth in the years ahead of us. And importantly, this week we had an acquisition that we announced, a partnership with a Texas bank called Veritex. Just a great group of individuals and leaders. They're going to be our colleagues soon, and we're very, very excited by this one as well.
What attracted you to this bank in particular, Steve?
Well, we have been in Texas now since 2009. We've been growing nicely. We're the largest SBA lender throughout the state, and we have a series of other businesses there. We're predominantly in Houston and Dallas, and that is exactly where this bank is located. And it's headquartered in Dallas. So it will allow us to bring the full franchise of our capabilities to our existing customers, their customers, and hopefully many more as we continue to invest and grow there.
So a lot of people were looking for Huntington Bank to make some kind of acquisition because growing your footprint is very much part of your mission right now. So this particular deal represents the first M&A announcement in some time for a traditional bank of your size or higher. I'm wondering, given the regulatory backdrop here, how much of the deregulation that so many people are anticipating from this White House factored into your decision to do this deal?
Well, there's clearly a more constructive business environment generally in this administration, and that's true for our industry as well. But for us, we manage the company in an aggregate moderate to low risk profile. We're always poised and ready to do acquisitions, but we have peer leading growth from the core, and that's the emphasis. We must grow our core businesses. Year over year, our loans were up 8%, deposits rounded to 8 as well. Great fee income growth, superb quarter in terms of both revenue increases, pre-provision net revenue, PPNR, NR, tangible book value up significantly year over year. It's literally hitting on all cylinders.
So given this backdrop here, and we've seen stronger stock prices for banks at large, do you think your competitors, your peers, other banks will follow in your footsteps and announce more tie-up? Are we going to start to see the wave of consolidation that so many people had been anticipating?
You know, I don't know. I'm not in investment banking. For us, this was the third bank acquisition of any size that we've done in 16 years. So it's not like we're a serial acquirer. I don't know that this triggers anything. But I do think this, as we went through this process, we were constructively met by our regulators, and this happened very quickly. We had a great level of trust and execution by both teams to get this done in a record time, roughly 30 days.
Steve, how do you think about the conversation around the Federal Reserve right now? I mean, we could be on the cusp of a changing Federal Reserve, a whole different environment, or we might be looking at what we've been looking at for the last couple of years, and that's, you know, just rate cuts whenever they're deserved, whenever inflation is under control. What do you guys, what's your base case?
Our base case is one rate cut later this year. The forward markets have been consistently wrong for years. And so we're geared with a neutral position. If the rate cuts happen, we'll benefit a bit. If they don't happen, we're fine. And we'll continue to manage the company with a lot of optionality with our future. We have terrific momentum coming into the third quarter, and typically the fourth quarter is our best quarter of the year.
And just to follow up on that, if there were to be a change of regime very imminently, if one Fed chair was gone and another one was in, how do you make business decisions in that environment? Would it change anything about how you operate over the next 3 to 6 months?
It really will have no impact on how we operate. We're meeting customer demand, both in our core markets, and we've expanded into the Carolinas. We've expanded now into Texas in a big way. And we have 8 specialty businesses that we've launched in the last 2.5 years nationally. So we've made a lot of investments. That's why we're generating peer-leading growth and returns, just under an 18% return this past quarter. And so our die is set. Our line of sight now is continued growth, and we have momentum. And we have just great colleagues, including wonderful new colleagues from Veritex and a terrific leader in Malcolm Holland.
I'd like to get a sense of what you're seeing from your customers. Your results certainly indicate that tariff uncertainty, however large it looms in the broader economy, hasn't really affected your growth trajectory. What are you seeing from your enterprise customers, your commercial customers, and your individual customers? How are your manufacturing clients managing through this uncertainty?
Well, there is some impact. I think we actually would have done more than 8% loan growth year over year had there been more certainty in the environment. I think inventory levels are a bit low going into the fourth quarter. I think they're going to get pulled down, so that'll be a headwind for us. But there was a lot of inventory management, purchasing management, I should say, bulking inventories up in the second quarter. So there's a little bit of a modest seesaw in terms of inventories. Overall, the businesses are doing well. It's a difficult environment to plan. There's a lot of effort around supply chain management and resetting sources of supply and managing on the margin where alternative suppliers can be brought in to avoid some of the higher tariffs. Having said that, again, the businesses are doing reasonably well, and the consumer is continuing to power through. Unemployment is very low by historical standards. So we have had a very low quarter in terms of net charge-offs, a second quarter in a row where our charge-offs have declined, and that 20 basis points, that's either peer leading or very, very close to it for our regional bank competitors. So I think the economy is fine. I believe the tax code that has just been enacted takes one of the big uncertainties off.
Well,
right?
we've been talking about
the tariffs, then we're the big stuff is out of the way.
Right. Well, one of the big things that's kind of before us right now is crypto legislation, right? The president signing the stablecoin bill right now. It's obviously been a theme on earnings calls as well. What does potentially wider adoption of stablecoins mean for Huntington, for the businesses that are your customers?
Look, we'll meet our customer demands, and if there's demand for stablecoin going forward, we'll clearly be a source of support for them in different ways. We're working through what that might look like. We don't have a lot of demand today for stablecoin. In fact, I'm not aware of any significant demand from any source, consumers or businesses, at this stage.
All right, Steve, thank you so much for joining us today. Steve Steinour is Chairman, President, and CEO of Huntington Bancshares, which did report its second quarter results today. Coming up, investors expressing frustration with a pain point in Amex's latest earnings report. You can see the stock there down 2.5%. It is our stock of the hour. This is The Close on Bloomberg. Our stock of the hour today is American Express. The share is taking a leg lower after its second quarter earnings report. Higher than expected expenses outshining the beat on the bottom line. Let's bring in Bloomberg's Paige Smith. And Paige, you look at the overall top line number, record card member spending, billed businesses totaling more than $416 billion. I mean, American Express's customers are spending. The card holders are spending.
Correct. I think that is very much the case here. It has continued to be the case with Amex. If you think of Amex's customer base, American Express's customer base, it's folks who are willing to spend and spend significantly on their cards, but also pay for access to premium rewards, perks, fees, sort of you name it, as well as things like lounge access, which is very important to American Express customers. So yes, you have these folks continuing to spend. It's travel season, it's the summer. Certainly there will be spending on these cards.
What did American Express say about the potential impact of tariffs on other countries, given that some of these credit card purchases are for sure imports?
Certainly, they did comment a little bit on, they said there was a bit of a tailwind, or excuse me, a bit of a headwind, I believe, on an FX adjusted basis, if I'm remembering correctly. But I think primarily the focus is that it's kind of full speed ahead, frankly, when it comes to spending, especially with this tier of folks. And American Express is known for global acceptance. There are folks that are traveling internationally, and it's a regular thing for them. It's not just folks who are splurging on summer vacations.
But when you look at the stock price today, now down 2.5%, all that spending by its customers who feel very comfortable doing so and are doing it while they're traveling. You mentioned all the perks that are involved in being an American Express member. That has a cost to it, and the costs of those are slowly rising here to the point where maybe investors aren't that comfortable with it.
Certainly, the company did call out that some consolidated expenses rose a little bit. The company attributed that to risk management and investment in technology investment, I would say. But as you said, it is a crowded space too. There's competition that American Express needs to keep in mind here. And I think investors and analysts are very closely watching that as well.
How is American Express preparing for a post-Genius Act world, right? Because one of the arguments from the stablecoin issuers is that this is going to make it, and from the president, is that it's going to make it so much easier to, do cross-border transactions and so on. If that indeed does pan out, maybe we won't need American Express as much.
I think, so there were a few questions on that on the call, actually, as you can imagine, and it's been something that the payment networks in particular have been hitting over the past couple of weeks in anticipation of the vote and also anticipation of the president signing the bill, which was widely expected as it occurred today. But the American Express's CEO, Steve Squeri, really addressed the question head on and essentially said, will this technology disrupt existing payment rails? The answer was absolutely not. But it is an opportunity for American Express, actually, either through partnerships or through their own offering, theoretically, to roll out some kind of stable coin foray, whether it's, again, something that they do independently or team up with someone.
Is that something that they were willing to say in any kind of detail, or it's kind of very broad brushstrokes right now?
It sort of seemed like it was very early days. I think that it would be very fair to say that discussions are ongoing, and we also saw that among the other big banks that reported earlier this week, actually, that stablecoin technology is top of mind. But in terms of exact plans, the CEO did not elaborate.
Paige, thank you so much. That is Bloomberg's Paige Smith there on American Express, and it will be fascinating to see how these companies, as well as the banks and many other payments companies, do react now that stablecoin is becoming an accepted way of doing business in the United States. And on that note, let's take a look at how Bitcoin is faring, because we are off our Monday record, but not by that much. It is down, a little bit of profit taking perhaps on the fact that we're at the end of crypto week now, and the successes that the crypto industry wanted did come to fruition, but there is more work to be done. Ether was a huge mover this week, up 20%. Dogecoin as well, Scarlett, I should mention, was up almost 20% today. The crypto asset universe now topping $4 trillion. But to put that into context, that's only, quote unquote, the size of Nvidia, right? So we are still talking about a fairly small world here. The S&P today,
or all the digital currencies, right?
All the altcoins, everything, the whole crypto universe. Stable coins is only $250 billion right now, so we'll see. It will expand, no doubt. The S&P coming into the closing area of the week, if you like, just off at about a fraction lower. Same with the Nasdaq 100, about 0.1%. We're looking forward to those tech earnings next week. And that 10-year yield, look, right back down to 442.95. We're obviously still in that range, but we backed way off the 450 that we saw when that kerfuffle broke out yesterday and the day before.
Yeah, well, yields are lower across the curve, certainly more so at the shorter end of the yield curve, with a lot more dovish talk coming from Federal Reserve officials, notably Fed Reserve Governor Christopher Waller. So for more market analysis to fold in all of that macro talk as well as some of the internal market dynamics, I want to welcome back Christina Hooper, Chief Market Strategist over at Man Group. Christina, great to speak with you again. And I know that there's a lot of focus on all the Fed speak, but they are entering a blackout period pretty soon because you've got the FOMC meeting coming up in about a week and a half. When you look at the bond kerfuffle, as Monty was putting it, we're seeing that not just in the U.S., but also in places like Japan as well. There's been a bit of a bond rout in JGPs, which, if you look at the absolute level, looks like nothing compared to the U.S., but is pretty notable for where it's been compared to the last 16 years.
Absolutely. I mean, if we look at the 30-year JGB yield, 25-year highs, all of this is because there is real concern about debt levels and the potential with this election coming up on Sunday that we could see an increase in fiscal stimulus, therefore an increase in debt, and the bond vigilantes have come out.
How dangerous a time is it right now? Because if you look at the market, it's pretty sanguine, Christina. I mean, especially this week, there was a lot to, process with the crypto week and so on. But at the same time, it feels like there's a lot more tail risks out there than the market is giving credence to.
Yeah, Vani, I think of this as the calm before the storm in so many different ways. If you think about where we are in the United States, stocks are very highly valued. To me, they're priced at or near perfection, and that means that they're very vulnerable to disappointment, and disappointment could come in a number of different forms. I think there's this view that we've dodged a bullet with tariffs and that the worst is over, when in fact the worst could very well be right ahead of us. And what we saw in the Federal Reserve Beige Book the other day was that there is real concern on the part of a lot of businesses. They're already seeing tariffs, and some of them are already passing that through to consumers, and it should show up in prices relatively soon. So I think that, for example, is one issue that hasn't really been contemplated and fully priced in.
And of course, you could see some of that in the components within the CPI report that we got earlier this week. The headline numbers looked encouraging, but if you dig a little deeper, there were indications that that is filtering through. How much do you expect to hear from companies as we get to the heart of earnings season that they're actually making plans, firm, concrete plans around tariffs and passing on that price increase to their end user?
I think as we move through earnings season, we'll hear that as a theme. I think we'll also hear as a theme that consumers are not as resilient as many would like to believe, certainly as Wall Street would like to believe. We've heard from banks thus far, it's been a pretty good earnings season, but we haven't gotten to the heart of, for example, consumer companies, and I think that's where we're going to start to hear some real issues. We even saw it in the FOMC minutes. They're worried very much about consumers substituting lower income households, which is a sign that things are getting worse.
None of that is going to show up in the big tech companies just yet, though. I mean, that's a whole separate asset class in and of themselves, and it all comes back to CapEx, how much money they're plowing into AI. Is this something that investors are going to be nervous about, as they have been, or are they going to look at it as a worthy investment, given that there seems to be some progress between the U.S. and China on the sales of some certain AI chips?
Yeah, Scarlett, I think there is a lot of positive sentiment right now, a lot of optimism. The jitters that we saw last year have, for the most part, gone by the wayside. And I think there's an expectation that companies see value in AI investment. They think the greater risk is not investing. And I certainly think that some of the inroads that we've seen recently, those developments with China, should bode well.
Christina, Scarlett mentioned some of the data earlier, but we also got consumer confidence data that improved today and inflation expectation data that improved. But one caveat I'll put in is that it was mostly Republicans and independents that feel that way in this particular survey data. But at the same time, it's better for the Fed if inflation expectations are going down. It shows they're anchored. Does that mean that maybe we're out of the woods a little bit with inflation, given all of the other data we've seen?
It's a great question, but I don't think so. I think this is the calm before the storm. When I talk to industry contacts, what they're saying is that they think we're going to see this show up in prices by the end of August, and that it can be quite oppressive for consumers. Because keep in mind, we have a significant tariff on Chinese goods, and for consumers, a large portion of what they're buying are Chinese goods.
We've had 12% of the S&P 500 report. It's not a huge amount. We're going to obviously get into peak earnings season in the next couple of weeks. At the same time, not that many of them were downbeat. You had obviously the likes of ASML coming out, Rio Tinto, a couple of the big ones, not just in the US, but saying that there were going to be tariff impacts. Do you anticipate, now that the banks are out of the way, that we're going to hear a lot more of that in the next 2 weeks?
I do think so. I think when we start to hear from consumer companies, we're going to get a very different kind of report where there's more uncertainty and there's a view that consumers are coming under greater pressure. And I think it will echo far more what we saw in the most recent Federal Reserve Beige Book.
We saw the president signing the stablecoin legislation into law today. How much of an impact does that have on what you're doing and how you're thinking about markets?
Well, I certainly think that over time, what we've seen is a view on the part of many investors, both retail and institutional, that cryptocurrencies, stable coins, can be part of an investment portfolio. And I think this takes us one step further. But again, I think it's personal preference. At
the expense of equities or fixed income, or?
I would suspect it's going to be at the expense a little bit of fixed income.
Christina, given that it impacts everybody, if you had to pick the next Federal Reserve chair, is Chris Waller now the best pick?
Well, right now we're seeing a beauty contest, right? And everyone is auditioning and they're getting out in front of the cameras. What I would say is that until next year, until the term is up for Chair Powell is the best choice because I think it speaks to the independence of the Fed. If we were to see a change now before his term is up, I think that could be a destabilizing force for markets when the Fed really has been and should be a stabilizing force.
All right, good stuff. Christina Hooper, Chief Market Strategist over at Man Group. Really appreciate your joining us today as we wrap up this week with earnings season really beginning in force. The big banks getting us started. And of course, next week we gear up for some big tech companies, Vani, that will give us some sense of direction of whether we'll be able to maintain current levels when it comes to the S&P, the NASDAQ, which are hovering at record highs, or whether there's reason to be concerned that perhaps estimates are too high and things are priced for perfection.
Yeah, you could say we started off on a good note, right? Because all of this volatility has been good for the banks. We saw that. We saw Betsy Graseck earlier being so excited about the rest of the year in terms of deals and pipeline and so on. So maybe we've had the good news and the less good news is coming, as Christina Hooper was saying.
We'll see how it all plays out. I mean, I look at the movers today, and you have utilities at the top of the heap. They're up 1.7%. All that demand, the AI demand, means that there's going to be a need for more power. And you're seeing some M&A start to percolate in this industry, certainly at the smaller end, the small cap scale, but it's going to certainly evolve into the large cap scale as well.
And it certainly seems like that's going to be the next stage of the AI story.
All right, we are moving you closer to the closing bell here. We've got full market coverage right here on Bloomberg as we join our colleagues over in Bloomberg Radio to bring you the closing bell. That's next.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Bonnie Quinn here with you and here to help take you through the closing bell. We've got a global simulcast. Tim Steinour joins us, as well as Isabel Lee. We bring together our Bloomberg Television, radio, and YouTube audiences worldwide as we parse through the most crucial moments of the trading day. And Tim, it doesn't look like a whole lot is going on when you look at the closing numbers here in the S&P 500, little changed, but it's been a walloper of a week in terms of some of the dynamics within.
Yeah, I think that's the exact right way to put it. The big banks reported, and certainly this week was a big one when it came to conversations and chatter around the future of Fed Chair Jay Powell and a lot of Fed speak ahead of that July 30th meeting. But if you thought this was a big week for earnings, check out what we got next week. Verizon, T-Mobile, AT&T, NXP, Lockheed Martin, Philip Morris, Coca-Cola. Are we going to hear about Sugar Coke? Maybe. Tesla next week as well. We'll get Southwest. We'll also get
That's just
Blackstone.
a sampler.
That's just a few. That's just a few.
But it's interesting because even with all the political grandstandings and even the recession warnings, the U.S. economy just really refuses to buckle, even with President Donald Trump berating Fed Chair Jerome Powell and newer central bankers really just debating the course of interest rates. We're still in a good shape, especially when it comes to the equity market.
It is pretty stunning, isn't it, Isabel? We just had Christina Hooper saying this is the calm before the storm, and it certainly feels like there could be more, at least squalls coming, let's put it that way, because we do have those tariffs. Just 1.5, I think, more weeks, 2 more weeks until the August 1st deadline. So, you know, we're bound to see more of those letters go out and more comments from the president. He couldn't even help himself. He was commenting on it earlier today during the signing of the Genius Act.
But that just goes to show that it can all be rolled out another week as well, because he's constantly moving goalposts and the deadlines are, well, they've proven to be somewhat flexible, at least from his perspective. Let's take a look at how things are shaping up here as the closing bells rang here on the floor of the New York Stock Exchange and over at the NASDAQ. You have the S&P 500 finishing basically unchanged at 62.96, so just below that 6,300 level, so very much holding near its record highs. The Dow Jones Industrial Average losing 1/3 of 1%, lower by 142 points, 44,341. The NASDAQ finishing marginally higher. And we take a look at the Russell 2000, the small caps. They are the laggards of the session, losing ground by 0.6% here on the day. Of course, when you look at how things fared for the week, we are looking at, let me just pull this up, gains all around here for the S&P 500. You have gains of about 4.9% for the Dow Industrials and 9.1% for the S&P 500.
You know, it just switched, but we were 250 in terms of gainers and decliners in the S&P 500. That's not how things settled, but pretty close to that. 255 stocks, moved higher. Isabel, 244 moved lower.
If we look at the IMAP, this also tells the story because, Scarlett, you mentioned it earlier, but utilities were the best performer. We're talking mainly, though, Vistra Energy, for example, these utilities that are involved in power consumption by AI companies and so on, up 1.7%. But energy companies in general down 1%. So there was a lot of stories going on underneath. It wasn't just crypto week.
And just a quick correction, when I gave those numbers, I'm sorry, I was referring to volume, not the actual index levels, because the index levels are not moving like that on a weekly basis. The S&P 500 marginally higher by 0.6%. The Nasdaq little changed on the week.
All right, well, let's talk to some of the stocks that were on the move today and this week as well. A few of the gainers on my radar included Charles Schwab, up 2.9%. The company did report second quarter earnings earlier today. It topped estimates. Client assets hit a new record. Trading revenue increased. Rick Wurster, the company's new-ish CEO, he said they are continuing to build out digital assets. And it'll include spot trading in Bitcoin and Ethereum. The company expects that to be a, quote, meaningful growth driver. Also watching shares of what's happening with crypto companies today because of that signing of the Genius Act in Washington. We heard comments from President Trump earlier today talking about that bill moving through Congress and ultimately ending up on his desk. Shares of Robinhood higher by 4% today. The president hailed that new law as a giant step to cement American dominance of global finance and crypto technology. It delivered a major victory for the digital asset industry. Robinhood CEO Vlad Tenev was actually at the event at the White House today. The president called him out by name just a little bit ago. And finally, here's an interesting one. California Resources. It's an energy and carbon management company based in California. It popped in late trading. You can see it on the chart right there, up close to 7% on the day. This after news reports that Governor Gavin Newsom of California is proposing a bill to streamline permitting for new oil wells. Environmental groups, though, are pushing back. They say it would wipe out scrutiny of the industry. California Resources up today by 6.7%.
On to the decliners, we have to start with Humana because shares closed just 1.5% lower, but intraday it was wild because the shares sank as much as 7.5%. That's the lowest since at least April 2017. So Humana lost its lawsuit seeking to reverse cuts to its Medicare bonus payments. So this is a blow for the insurer because they really hoped that the court would restore billions in revenue. So we're definitely going to see a squeeze in profits. We have Barclays telling Bloomberg in April that a win would have doubled their 2026 profits. So this is why stocks are edging down for now. Next is Lucid. So this is also in the red, down by 2.5%. Shares are just really consolidating after the massive jump we saw on Thursday, that's yesterday, which we saw the most in 2 years. So this came after the company said it was planning to team up with Uber and self-driving tech startup Nuro to launch a robo-taxi fleet. And last we have Chevron. Shares are down by almost 1%. So Chevron won the arbitration battle with Exxon, which is its larger rival, to finally close its acquisition of Hess. So the victory comes after more than 20 months after the deal was announced, which was worth $53 billion. So really at least a lot of overhang there lifted in the industry.
Yeah, overhang lifted, but it was something that investors were anticipating, which might explain why the shares ended up finishing lower. Let's take a look at what's happening across fixed income. The Treasury yield down across the curve, but certainly more so at the shorter end of the curve. The 2-year now down about 3 basis points to 3.86%. The 30-year finishing the week below 5%. But remember, it did reach about 5.07% on the day that President Trump, there were reports that President Trump was considering firing Jay Powell, really threatening the independence of the Federal Reserve.
Well, this story in the Wall Street Journal got our attention this afternoon, maybe because I'm always hungry. But if you've been to a McDonald's recently and you've ordered maybe, I don't know, some sort of chicken sandwich, a McChicken sandwich, and it hasn't come with lettuce, there's actually a reason why. It's because the snack wraps that they brought back have been such a hit that some McDonald's are actually running out of lettuce.
This is shocking because I can't ever imagine eating a burger without lettuce, tomato, bread. Even maybe I can live without the bread, but definitely not
I thought you were going to
lettuce.
say sesame seed buns, because isn't that part of the whole...
Pickle also
That's the
will be
jingle,
good.
right?
Part of the
Terribly
commercial.
sad. It might be literally the only good thing in that whole snack. I mean, good as a nutritious.
I know what you
don't
meant.
at me,
It
McDonald's.
was still funny.
It just goes to show how big a player McDonald's is in anything, right? When demand for any of its goods changes, like it absorbs so much of the supply chain that things can run out. It on its own, if it launches a new product, there's a run on everything that goes into that particular sandwich.
And that's why you have to wonder if the person who decided that this should make a comeback and thought it was going to be a success and then enacted it, then why didn't they have enough lettuce? Why do they have
You got
all
to call Tim Cook in situations like that. That's his specialty. He's the supply chain guy.
So we're saying that McDonald's needs a new supply chain specialist?
I didn't say it, but
lettuce specialist.
Didn't they have an issue with eggs too when they brought back breakfast?
They did, but they defended themselves. They said that the outage was brief and now resolved. So there is that.
Okay, people need their protein in the morning. All right, let's talk about another story, which is we know that private schools are a big deal here, certainly in the tri-state area. Have you heard of Harrow, which is a boarding school famed in the UK?
I had not heard of it before this story.
Okay, I mean, it's like the second most famous British boarding school after Eton, but it now will be opening a New York-based offshoot. Vani, I know you've heard of Harrow.
I've heard of Harrow, yeah, tangentially since it's British, but yeah, this particular one is going to be run by the Amity Education Group, which is an Indian family foundation.
So it's licensed.
Exactly, it's fascinating. Also, I mean, I don't know about the visa situation and when they're going to be able to get that all sorted out, because not immediately, apparently. But if you were a Harry Potter fan and you wanted to go to the school that served as a stand-in for the Harry Potter movie, then you would want to go here, because this particular school actually served as that stand-in.
Yeah, well, the one in New York won't be the stand-in for the Harry Potter school, but they're going to be opening one in New York, and it's not in the city of New York, and it's not in Long Island, and it's not in the Hamptons, which is where a lot of New York's moneyed elite summer and have their second homes, but it's going to be somewhere in between. So it's kind of a school for people who kind of make their way between their Manhattan homes and their Hampton homes. And
$75,000 is the price tag for tuition, right?
Including boarding, though, Tim.
So, which actually seems, if you're in the world of New York City private schools, kind of the cost of a day school here in New York City.
You're saying it's reasonable.
Yeah, which is a different conversation, the cost of education. But all right, grab your Quidditch brooms and head on over to the new school, Harrow International School in New York. That is going to do it for our cross-platform coverage of the market close. You guys have a great weekend, because we will see you back here, same time, same place on Monday.
All right, Bonnie and I will continue on here on Bloomberg Markets The Close, because coming up, Doug Ramsey, Luthold Group Chief Investment Officer, will be joining us to give us his outlook on earnings and what sectors have caught his eye in this current market, which a lot of people say is priced for perfection. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Vani Quinn. And let's take a look at where markets closed out this session. A little bit of profit taking, it seems, this Friday. Of course, you never know what's coming next week, so maybe it's a wise thing to do. Nevertheless, we still have the S&P 500 very close to that 6,300 mark, 62.96. And as you said, Scarlett, on the week, we're up about 0.6%. So not a bad week, given that earnings season has already started. Same for the Nasdaq 100, down fractionally, but just to the tune of 15 points or so. A lot of action in the bond market this week, as we know. That 10-year yield back down to 4.4215. We had, a drop of about 4 or 5 basis points across the curve earlier today, and that momentum just continued throughout the session. In fact, the 30-year yield is back below 5%, albeit just barely. And I guess we have to point out what crypto is doing, right? This crypto week in Washington, D.C. We have the main crypto, the OG of the crypto world, Bitcoin, off its record, which it set on Monday, but not by that much. We're still above $117,000 a coin.
Yeah, but after $123,000 earlier in the week, it does feel like a little bit of a disappointment. Maybe it's buy on rumor, sell on news, because the president did sign the stablecoin legislation today and turn that into law. Let's take a look at a couple of individual movers, and we'll stay on that crypto theme, because you have gains in Coinbase and Robinhood on the heels of Crypto Week. Those gains actually put them at record highs. They might have certainly reached that point during intraday trading as well. Let's take a look at Chevron, down 0.9%, even after it won a ruling by an arbitration court that allows it to move forward with buying Hess for $5 billion, putting an end to what has been a 20-month saga, basically overcoming a challenge by its larger rival ExxonMobil. But as our reporters in Houston tell us, this was something that investors had largely expected, so not a huge surprise that it did prevail. Our top story this hour It is still the early innings of earnings season, but things do start ramping up pretty soon, with investors eyeing a big upcoming week of results. You've got Tesla and Alphabet set to kick things off for the Mag 7 names, while legacy tech also get their moment. Intel, IBM, Texas Instruments, and ServiceNow will be reporting. We'll be sitting down with Gene Munster of Deepwater Asset Management to get his potential winners and losers. Also, reports from Coca-Cola, Chipotle, Hilton, and American Airlines next week will provide a glimpse into just how well consumer spending is holding up.
Joining us now is Doug Ramsey, CIO at the Leuthold Group. Doug, is it for sure that we're looking at peak earnings, or is there the potential for earnings to continue to peak?
I think they're going to be okay in the second half. And I mean, I just looked through the first half results so far. What's clear to me is there's a little bit of inflation supporting these earnings numbers and these sales numbers. So the latest CPI report year over year showed the headline CPI up 2.7% year over year. I actually think underlying inflation is a little bit higher than that, and that's benefiting both the top and the bottom line. And I would not expect to see that change into the second half.
So that brings me to the question of how are companies actually doing it then? Because we are seeing a consumer that's, being hit on all fronts, really. The potential for tariffs, inflation, which, as you say, has been coming down a little bit, but not, by a huge amount. The concern still that the workforce might actually be under a little bit of pressure. Yet the companies are beating and they are widening their margins.
Well, the high end's doing very well, in part because of the stock market. And I just think it's astounding that you've now got top 10% of households accounting for nearly 50% of consumption. And they're not under a lot of pressure because of their exposure to assets. As a matter of fact, I mean, that's been a theme, I think, behind the resilience of the economy. And I'm sorry, are you ready for another acronym?
Yes,
I apologize in advance, but we've been talking about SMITE. The stock market is the economy. I mean, the stock market closed today at 207% of GDP, all-time record. I mean, well, the wealth effect has always been one of the transmission mechanisms of easier Fed policy. But that's more true than ever today because the stock market's never been this large relative to the economy. So it's a driver of both real growth, and as you alluded to, real growth, especially some of the employment numbers, have really started to decelerate. I mean, they're not contracting, but they're showing that this mix of nominal growth is less real and maybe a little bit more inflation. As I said earlier, we're picking that up in earnings numbers too.
Another group that's benefiting from the stock market are the financials. We've seen an incredible run in this group of stocks, certainly outperforming the S&P 500 and the big tech names as well. What does that signal to you, Doug?
Well, I think part of it is this broader deregulation theme brought on by the new administration. That's part of it, but it also tells us that financial conditions are still pretty easy. I mean, especially to see that investment banking and brokerage group, leading the way among the financials. And we've owned that group for a while. And when our industry group work turned bullish on it a while back, we were somewhat skeptical, thinking that, it's late economic cycle, it's a, pretty frothy bull market, but, sure enough, it's done well and is leading the way. And it would be very unusual for the market to top out here with, market breadth at a new high recently and the financials leading the way. I mean, anything can happen, but it tells us that financial conditions are still quite easy.
What does that say about, you mentioned that you own a lot of financials, and I believe they're your biggest sector overweight as well, 21% of your portfolio. When you talk about your optimism for these financials, does that extend to other subgroups within financials, such as the insurers?
Yeah, we do own the P&C insurers. We own, we devise some of our own groups. One of them is just called Developed Big Banks. We own that group. We have recently sold the regional banks. Just some concerns starting to crop up there on credit quality. Maybe this, commercial real estate issue that's managed to have been swept under the rug now for the last 3.5, 4 years is starting to rear its ugly head in the results of the regional banks, which have a lot of exposure to commercial real estate. But it's generally, our group work across the financials is pretty broadly bullish, with the exception of that move we've recently made to sell the regional banks.
All right, Doug, really appreciate you joining us. And of course, the regional banks will be reporting their results in the coming days and weeks as well. Doug Ramsey is CIO at the Leuthold Group. Coming up, Crypto Week finishing off with a bang as the president signs the Genius Act into law. We've got a key stakeholder standing by, ready to give us his reaction. Coinbase's Chief Policy Officer, Faryar Shirzad, will be joining us next. This is The Close on Bloomberg.
This afternoon, we take a giant step to cement American dominance of global finance and crypto technology as we sign the landmark Genius Act into law. I also remain fully committed to my pledge never to allow the creation of a central bank digital currency in America. It won't happen.
And that was President Trump last hour while signing the stablecoin regulation bill known as the Genius Act into law. Let's talk now to a key stakeholder from the world of cryptocurrency. Faryar Shirzad is Chief Policy Officer at Coinbase. He is smiling. He's joining us from Washington, D.C. because he was attending the bill signing over at the White House. Faryar, good to speak with you. Just give us a little bit of color. What was that like? What was the mood like in the room? Because this was a long time coming.
Oh, it was extraordinary, Scarlett. I mean, think about it. A year after the president went to Nashville and talked about becoming the first crypto president, we have a stablecoin bill that's been signed into law, and we have the president of the United States committing to the world again that he's going to get clarity, which is the market structure bill, done and signed and put that into law. So it's unbelievable. We'll have the framework of making the U.S. The leader in the next generation of financial innovation, and what an extraordinary moment for the American people.
As you made clear, there are still two other bills that need to be signed into law because as part of Crypto Week, there's a trio of bills. From where you sit, what do the three bills featured in Crypto Week allow Coinbase to do that it couldn't do before?
Well, the stablecoin bill, the Genius Act, which just got signed into law, creates a clear federal framework for the issuance of dollar-backed stablecoins. So what this means is that the next generation of the dollar, the digitally native dollar, is now can be issued in the United States subject to U.S. rules and U.S. oversight in a way that allows it to be used for the most regulated payments activities we have in our economy. So stablecoins right now are about $250 billion in market cap. They turn over on the order of $2 or $3 trillion. And now you have a law in the United States that promotes their issuance in the United States, and they can be used for collateral management purposes, settlement between banks, for retail purposes, and so on. So we're about to enter into a payments revolution, and today's bill signing by the president has put us well underway to achieve that outcome.
Faryar, tell us, were you actually a little bit nervous this week because there were procedural votes that were held up by the House Freedom Caucus, or was that all theatre? Did you know that this was all going to work out in the end?
I've worked on a lot of legislation, and when you get people coming in and trying to trip it up, it's actually a sign that you're close to actually getting something done. So you had a bunch of different constituents who came out of the woodwork who were trying to use the bill to piggyback and put other initiatives on. So I thought we were going to get there, and in the end, with amazing work by the president, by Speaker Johnson, by Chairman French Hill, we got it done. The other thing that the House did, which was hugely consequential, was to pass the Clarity Act. This creates a federal framework around what the crypto markets are like. So delineates a role of the SEC, the role of the CFTC. You had 78 Democrats join a unified Republican caucus in sending that bill to the Senate, and that's a huge, huge step forward.
Yeah, but that's the problem, isn't it, Faryar? Will the Senate actually take up that bill, or will the Senate want to have completely different language, a completely different legislative agenda here, and who are you working on specifically when it comes to that?
I think they'll get it done. It's hard if you have 78 Democrats in the House endorsing something like this for the Senate not to take it up, and we've got champions on both sides of the aisle. And on the Democratic side, we've got people like Senator Gillibrand in New York, who's put her shoulder to the wheel to get this done. Leader Schumer, I know, wants to get this done. Ranking member Klobuchar on the banking committee is very committed to it, Congressman Gallego and others. So I think we'll get it done. And the Republicans are very committed to producing a bipartisan product. So we're well on our way to get this done, and we'll hopefully complete it by the end of September deadline that the White House and congressional Republican leadership have set for themselves.
Well, the industry is certainly looking ahead and looking forward to that. When you do have all three bills passed, turned into law, a lot of people I've heard say regulation in the U.S. is finally starting to catch up with innovation. I mean, there's still a gap, but that gap has closed just a bit. I'm wondering, from where you sit, when you look at where things are globally, which country serves as a model for both regulation and innovation? Who gets it best? Who gets it done right?
Well, right now there are a number of economies, including the European Union, who've done a really good job in creating the regulatory framework. But it's only the U.S. that has the scale and the depth of the ecosystem of innovators that allow that regulatory clarity to translate into breakthrough innovations. So even though we're behind on the regulatory side, I think with Congress acting with speed under the, in collaboration with President Trump, I think we'll see breakthrough developments happening very quickly. So hopefully we get the market structure bill done and we'll be off to the races.
What does it all mean for companies such as PayPal, Stripe, all these companies that were sort of, they thought at the head of the revolution? And does it mean that we're just going to see a proliferation of these stablecoin companies like we're seeing, Bitcoin treasury companies?
Well, payments is one of the most antiquated aspects of our financial system. As a consumer, when you use one of the payment apps, you perceive that the payment occurs instantaneously. But behind the scenes, they're quite expensive processes and take multiple days to ultimately settle out. And so what stablecoins allow is for that perceived customer experience to be matched with a back-end infrastructure that actually moves at the speed of what the app makes you think it's moving at. And so you'll be able to have instantaneous payments move with virtually no cost with the same ease that you send a text message. So Stripe, PayPal, Visa, the big banks are all now integrating stablecoin-based payments into their payment infrastructure, and that will mean better, safer, cheaper, less risky payments in the U.S. economy. You'll start with a big efficiency gain, but you'll also, with this blockchain technology, can do programmability. And so the first generation is going to be innovation. The next generation, or first generation is going to be efficiency. The next generation is going to be innovation. It's exciting.
All right, Coinbase Chief Policy Officer Faryar Shirzad joining us. Thank you so much. Still ahead, AI targeting the infamous Wall Street work week. We've got more on that coming up. This is The Close on Bloomberg. AI is targeting the infamous Wall Street investment banker grind, though adoption of the technology raises some questions about whether junior investment bankers will go from overworked to perhaps underprepared. Our next guest says that his company's aim is efficiency. Gabe Stengel, the founder and CEO of Rogo, a Gen AI platform used by over 60 Wall Street firms whose partners include OpenAI and Google Gemini, joins us now. So Gabe, it's great to speak with you, and there's been a lot of talk about how there's ways to make the whole investment banking process, the grind, the work that they need to do, the 100-hour weeks more efficient. Tell us how your AI does that.
Scarlett, Vani, thank you so much for having me today. Rogo is building the leading AI solution for investment banks, and that means we want to help leading partners like Nomura, Lazard, Moelis, and others transform the way that they do financial work. It's no secret that AI is going mainstream in Wall Street, and the firms that are able to use AI to augment their junior professionals, make them more productive, are going to have a huge advantage over the firms that can't.
So is your AI creating slide decks and pitch books for them?
We can help create slide decks, we can help draft S1s, even help draft merger models too. Our goal is to help bankers focus on the more interesting, the more strategic work, the stuff that actually helps their clientele, rather than playing around with tools from the 1980s at 3 a.m. in PowerPoint, Excel, and so on.
So I was looking on your website, and the types of questions that I guess you're expecting analysts to ask are things like, compare valuation multiples of Microsoft, or expected EBITDA revenues for Nvidia in the third quarter, and that's great and everything. But what if something goes wrong? Is there any kind of an insurance policy?
Look, these banks have built-in insurance policies. That's why there's analysts, associates, VPs, directors, exec directors, and MDs. The result of a Rogo question should always be checked by an investment banker, and our goal is to expedite and help folks find insights they wouldn't have otherwise. Our goal isn't to replace the work that people are already doing.
We'll get to whether it will replace eventually or not in a minute, but I do want to ask you what goes into your LLMs. So obviously FactSet, Dow Jones, I think on your website you have Capital IQ as well. So it's all publicly available information. Is it just faster than the analysts that can look up Morningstar?
I mean, we work with all those great data providers, Refinitiv, FactSet, Cap IQ, PitchBook, just to name a few, but we also help these firms connect AI into their internal data and take advantage of their internal data too. And the same way that, when a new analyst starts at JP Morgan or Lazard or any other firm, they need to learn the way that that firm works, the way that that firm thinks about market comps, M&A, and so on. We help firms train their AI analysts as well.
Some parts of the junior banking grind is very instructive, right? The financial modeling and the synthesizing of data really helps build up a discipline, creates a foundation, and gives the bankers confidence to be able to sit in a room with senior bankers and with clients as well. Do you worry, or do the users worry, that the AI will strip that from them?
We do hear that concern. Knowing what users do on our platform, a lot of it is pedagogical. Hey, how do I calculate this adjusted EBITDA multiple? Hey, how does this industry think about supply chains? We help investment bankers actually ramp more quickly. And yes, there are types of work that they won't have to do manually anymore. I think the best investment bankers are very ambitious and very smart, and they'll want to learn the details.
So your own personal story plays into this as well, because you studied computer science in Princeton and your senior thesis was on AI assistance for finance. Did you go into investment banking with the idea that you're going to disrupt it later on?
I wish I could say I was. My co-founder, John Willett, studied economics and finance. I studied computer science, and we wanted to work together. And it was a very inspiring and interesting thing for us to create AI tools that could make our classmates smarter and more efficient. And then when John went to JP Morgan to do investment banking and I went to Lazard to do investment banking, it became abundantly clear that that work we began at Princeton could really transform an industry that needed the disruption.
It does feel like a lot of people could potentially do this, right? So you might be competing with Mosaic and maybe others down the road. What gives you a wider economic moat? Is it the companies that you get into that you convince to allow, your systems to, let's say, infiltrate?
So, banks, hedge funds, private equity firms spend $70 billion a year on financial data. The market for financial work, financial insight is far bigger. There's a lot to play for. I think the value that Rogo provides is we deeply understand financial workflows. Everyone on our team has sat in an investment bank or in an investment firm like Blackstone or Apollo, and we sit side by side with AI researchers who train models on private data such that our answers are more empathetic with a banker and they actually understand what folks are doing.
Well, that sounds good. Congratulations.
Thank you very
All right,
much.
and the junior banker jobs are safe, yeah?
For now.
There we go.
That's the key line.
Gabe Stengel, founder and CEO of Rogo, joining us there, and we thank him. And sticking with AI, major players in the space like Alphabet and IBM are among those reporting earnings next week. For more on what he's expecting to see, we're joined by Gene Munster, managing partner at Deepwater Asset Management. So let's begin with Tesla. Gene, I can't not begin with Tesla. We have seen a little bit of, a give back in the share price in recent days. What's Tesla going to tell us next week?
Well, this is a pretty unique setup in the sense that the numbers, the commentary about the September demand really doesn't matter much, in part because this pull forward that we're going to see from the ending of the tax credit at the end of September is really going to add so much noise to whatever they say about the September quarter that it's not going to be particularly useful, at least on the electrification front and the car front. But just to kind of put some quick metrics around that, is that deliveries were down 14% in the June quarter. They're probably going to be up in the September quarter and then drop back down to maybe 10% decline in the December quarter. So you're going to see this spike up. So I just want to, that's going to be one of the kind of the early conversations. But of course, all the focus is going to be on how robotax is progressing. And if you've been keeping close tabs here, this will not be news to you. But they launched with about 15 vehicles. That was back in the middle of June. They're currently at about 40 vehicles in Austin, and the geo-fenced area has gone from about 20 square miles to just under 40, so they've essentially doubled both of them. Now, that compares to Waymo, which just bumped up their geo-fence to about 90 square miles in Austin. And so what I want to emphasize here is that when it comes to robotaxi and the commentary on the quarter, this is really going to be the center of gravity of analyst questions and investor questions. it's less about the absolute numbers, how many cities or what the square miles are. It's more about how quickly they're going to get there. And as a reminder, Elon said a month ago that they're going to get to about 1,000 of these robo-taxis in a few months. So he left it kind of loose. But my sense is they're not going to get to that 1,000, but they will get to a few hundred. And if they do that, I think it's going to be viewed as a positive for the stock.
Yeah, I mean, it's not about deliveries. It's all about progress on robo-taxis. Let's talk about Alphabet, because a lot of that has to do with CapEx, how much it's spending. And it's been a bit of a laggard when you look at the share price performance, certainly compared to the NASDAQ and the rest of the Magnificent Seven. What is it about Alphabet that it has to convince investors that it is keeping pace in the AI game?
So I've got a long history with Alphabet as an analyst, as an investor, up until about 6-9 months ago, very much behind the opportunity, the data that they have around search, and to be able to apply that to AI. And it's becoming more clear that they're just in a tough spot. So let's say that they take the positive here, and let's say that they surprise at the upside on the search business. That's still going to beg the question for investors, what happens to search in 3 quarters or a couple years down the road? If we rewind to what they said back in the end of May at their Google Cloud conference, at their Google I/O conference, they talked about this new AI mode within Google that rolled out in the US. It's available, anybody can do it, and it's also now available in India. But the piece is that it's hard for people to find this. You have to go to Google proper, and then there's an AI mode button. So I think the actual usage of it is pretty low. And if you experiment with it, it really emphasizes 2 things. Number one is the product's actually really good when it comes to comparing to other generative AI, like GPT, for example. But when you look at the 10 blue links challenge, like how do you monetize that? It still begs the question, how are they going to thread that needle of giving the experience that consumers want, but also maintaining that monetization? So to answer your question, these next few quarters are going to be tough for Google, because I think it's going to be hard to get investors some confidence that they're not going to see the effects of this shift.
Gene, we're pretty out of time, but just to look at the stock prices of the Mag 7, I mean, some of them are at all-time highs now. I'm looking at NVIDIA, and some of them aren't. What would be your best pick right now if you were going to pick 1 or 2 of them?
It's very simple, is that we are much earlier in AI than what I think most people expect, much earlier than what I would have said a few months ago. And these companies, the big ones, the small ones, they're going to continue to benefit. Getting AI exposure, I think we're going to still have a phenomenal 3-year bull run in the market here.
All right, good stuff. Gene Munster, always a pleasure speaking with you, giving us an advanced sneak preview into the earnings that matter for next week. He is managing partner at Deepwater Asset Management. And in terms of how markets closed the week, this week, we finished a little change on the S&P 500, but don't be fooled, we are pretty much sitting at record highs here, just below 6,300 for the S&P 500, and similar for the NASDAQ. That did close up marginally by about 0.1% for the NASDAQ composite. Yields lower across the curve, Vonnie, and that really is tied to what Fed Governor Chris Waller said. He made the case yet again for a rate cut this month. Not that markets are counting on a rate cut in July, but the fact that you have someone who's very dovish, who is seen as a leading contender, potentially, of being the next Fed chief as well.
And will he dissent or not? And will markets look at that dissent as watering down monetary policy if we start to see more dissents more of the time? There are so many questions. And what's fascinating is that basically everyone who's been on the show so far has been pretty optimistic, right? Maybe with the exception of Christina Hooper.
Yeah, so this is something we'll keep an eye on. It's worth noting here that Bitcoin on the tail end of crypto week finishing down about 2%, but it did hit a record high of 123,000 earlier this week. This is The Close on Bloomberg. It's time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Wendell Huang. He is the CFO at Taiwan Semiconductor Manufacturing, and he says macro uncertainties have prompted the chipmaker to get a bit conservative about their current forecast. He spoke on Bloomberg earlier today, and here's what he told us about potential pressures from tariffs.
Basically, tariffs would not directly impact us, but it will impact the end markets. So if the end market's demand drops, and ultimately it will affect us. We do have certain assumptions in there, which I think everybody has its own assumptions on how much impact there may be.
So a little bit of nuance there to their forecast, which they did raise earlier this week because of what they're seeing in terms of demand.
Absolutely. And of course, ASML, one of their competitors, and that stock tanked after it gave a forecast where it said, look, we don't know what's happening.
Tariffs on all that.
It's really a tough one for any CEO. I would not want to be a CFO. Well, that's not true if anyone wants a CFO. But anyway, I'm watching Mancio Ortega, the Zara founder. Inditex, obviously, his private investment firm is on a global deal spree, and apparently it has to do this every year. So this year alone, it snapped up a 5-star Paris hotel, a Florida apartment block, and a building in Barcelona, just among 3 of its transactions. These ones totaling more than $500 million. It's looking to avoid wealth taxes, Scarlett, and obviously this is, something that happens all around the world with these billionaires every year. The dividends alone from Inditex allowed him, or forced the family office to make $500 million of acquisitions, or they would have had to pay tax, and Spain taxes its wealthy people quite highly.
Yeah.
I do wonder, though, if sometimes they don't think to themselves, let's just pay the tax.
Well, no, because I think their DNA doesn't allow them to do that. By the way, Ortega has a net worth of about $103.7 billion, according to the Bloomberg Billionaires Index. So if he wanted to, he could afford it. Let's move on to a third on the docket. Stephen Colbert, after a decade of hosting The Late Show, his run is now coming to an end. CBS canceling the show, saying the decision is, quote, purely financial. Stephen Colbert made a statement on the show. It was very short, it was very brief, and lots of questions remain whether this is tied to the sale of Paramount.
Yeah, I mean, Rich Greenfield had a good note on this earlier, and he said essentially, look, it's not really tied to deals, it's more tied to the fact that linear TV entertainment is just going away, and it's going away fast. And, Jimmy Kimmel came out and said, this is terrible, I'm so sad that Stephen Colbert is going away. But, Jimmy, maybe don't act so fast, because maybe you'll be next,
Yeah, well, certainly the president has tweeted about it, and that's what he was suggesting as well.
Apparently, destination viewing on linear TV just isn't a thing anymore. But honestly, those Netflix series where you have to wait till the following Sunday for the next... Yeah. Isn't that the same thing? That's basically destination viewing.
Yeah, but that's binge viewing. The clips of these shows do quite well, though. I mean, if you look on YouTube, it's not consistent, but there are bits and pieces that do very well.
Very, very true, and it's one way of guiding the bar higher for content, right?
Sure, absolutely.
Yeah. Well, from top 3 to next up, where we highlight the entrepreneurs and trendsetters moving the needle in the markets, technology, and venture capital space. Today, we're watching Obey, that's OBE. With an accent. The digital fitness platform for women was just acquired by Dear Media, the largest podcast network for women. For more on this partnership, we're joined by Mark Mullet, co-founder of Obey Fitness, and that's Mark. Michael Bostic also joins us. He's founder and CEO of Dear Media. Mike, I'm actually going to start with you, if that's okay. What prompted you to complete this acquisition, to go for this purchase?
Well, Mark has done an incredible job with his team building a real community on a real tech platform that's done an amazing job catering to an audience that we as a company have been looking to serve since the beginning. And as we continue to look outwardly and figure out how to diversify, continue to build our business, have a place of, where we can bring our audiences and really serve them in a different way, this was really a no-brainer. I've grown to come to admire Mark for years and years. He has a former career in entertainment that really aligns with ours. And this is just the next step for Dear Media to kind of give our audience a sense of place and continue to serve them in a different way beyond just the typical ad revenue models.
All right, well, congratulations, and congratulations to you, Mark. I'm curious, can you give us any details about the financials, how well you did out of the deal, and what you plan to do next now that you've been acquired and presumably have some freedom?
Yeah, thank you, and thanks for having us. We're not talking about the financials of the deal, but everyone's really excited about the deal itself and the go forward. As Michael said, we are here to serve our audience better and in bigger ways. And where the two companies really come together is we are here to entertain, we are here to empower, and we are here to educate. And what we know is our audience wants more from us. So on the fitness front, we'll be doing far more with Obey, and on the entertainment front and lifestyle front with Dear Media, we're about to amplify that footprint in major ways.
Can you give us some specific examples of how you see being part of the Dear Media portfolio changing the content that you do produce?
Yeah, that's a great question. So on the Obey front, it really won't change the content at all, but what it'll do is it'll expose us to an entirely new community of Dear Media listeners. And I think what's really interesting about the digital fitness category is we obviously saw crazy tailwinds during COVID, but it's continued to grow since then. That said, cost of acquisition, channel of acquisition is a challenge. And I think most CEOs and founders and operators would agree with that across fitness and other categories. Dear Media operates at the top of a really phenomenal funnel of engaged audiences that are analogous with our product. So we're excited to get them in the door because the Obey product itself is so sticky, so fun, so retentive.
So, Michael, let me ask that question to you. How do you see Obey Fitness showing up on the Dear Media platform? How much of that will be visible to your users?
Yeah, well, you know, Obey's been a partner of Dear Media for a very long time. We've done very well partnering the brands together. I think this gives the platform a lot more visibility. One of the reasons why I personally started the company is not only to build a great media company, but also to aggregate this flywheel of attention so that you're able to kind of leverage some of these opportunities with some of the consumer brands and now tech platforms that we've invested in. And this is really us being able to serve our audience in a different way and really funnel them to what we believe is best in class, whatever category that may be. This happens obviously to be in the tech fitness space, but whether that's in, you know, commerce or CPG or health or wellness, Dear Media is well positioned to introduce our audience to all sorts of opportunities and then really give those brands and companies a significant lift because we have such a direct and intimate relationship with our audiences.
Mark, you must have given this a lot of thought, this particular issue, and that is, how do you compete with all of the other platforms that are out there? So there's obviously Allo, there is Rumble for boxing, there is, you know, and even the class passes of the world. How do you get your customers and retain them?
Yeah, that's a great question. And there is definitely considerable saturation in the category, especially post-pandemic. But the fitness business, and I think broader lifestyle in general, is kind of like the food business, right? Everybody's got to eat. There's something for everyone. You try something new depending on the day, the week, your mood, your life stage. So Obey's really found an incredible audience in our community. We're looking forward to expanding that audience. And I think what's really special about what we do is it's filled with variety of instructor, modality, skill level.
Can I push you a tiny bit further and ask you, what is the tipping point? Is it price? Is it, you know, inclusion and who is actually, you know, making these videos on the website? What have you defined that yet?
I think it's variety. I really, really do. People want to do something different every single day. They want progressive programs and they want a technical infrastructure that really speaks to them and their needs and their abilities. Price, of course, matters. And when you look at the current market where people are doing multiple things, maybe they belong to a gym or they go to a yoga studio, they walk with their friends, the price has to fit in their budget so that they can do it all. I think that same variety is relevant to what we do at Dear Media with podcasts. There is something for everyone. We have so many points of view, so many voices, so many takeaways, so many ways to laugh, to learn, to just have a great time. And that's another way the two companies bonded so well so quickly.
Michael, final question to you, and it has more to do with podcasts because you are the largest podcast network for women. How do you see, what's the next iteration of podcasts? Because we've seen podcasts go from something where people are in studios and it's an audio-only product to now video podcasts where people can see the hosts interact with their guests. What's the next stage?
Well, interestingly enough, you know, I've hosted my own podcast for close to a decade now, but if you hear me talking on forums like this, I very rarely refer to them as podcasts. I call them just shows at this point. They're video, they're on every major platform, they're relevant media, they're not new media. You have presidential elections being determined in many cases by some of the guests and some of the shows that are happening here. So for me, I look at this as a new wave of where real audiences come to have an authentic conversation with people. And it doesn't matter if it's on an audio version or, you know, platform, or if it's on a video platform or if it's a live event. I really just look at them as shows. And I think we're going to see more and more creators and hosts jump into this medium, as well as more and more businesses and brands start to engage with this medium. I'm lucky now that at least 10 years later, after being in the space, at least people know what podcasts are. But I think they're moving into just being called shows at this point.
All right, Mark Mullet, really appreciate your joining us, co-founder of Obey Fitness, as well as Michael Bosstick. He is the founder and CEO of Dear Media. Still ahead on The Close, we're going to set you up for what you need to watch for over the next week. And here's a tip, lots of earnings. This is The Close on Bloomberg. All right, let's take a look at what's coming up in the next week. You've got Treasury Secretary Scott Bessent visiting Japan for trade talks, so we'll look for some kind of progress on that, plus earnings from Verizon and Domino's.
And of course, we're entering the blackout period for the Fed, but we have Fed Chair Powell speaking on Tuesday. No doubt everybody will be glued to that speech to see what else comes out of it.
And the Mag 7 earnings kick off on Wednesday with Tesla and Alphabet reporting.
The ECB rate decision Thursday, that's going to be so important for the euro and the dynamics that have been, attached to the euro versus the US dollar. And of course, Trump visits Scotland on Friday.
And that does it for us on The Close. Balance of Power's up next. Have a great weekend, everyone. This is Bloomberg.